The traditional 60-40 portfolio once served as a reliable framework, 60% stocks for growth, 40% bonds for stability. But when inflation surged and correlations broke down, it exposed a core flaw. Risk wasn't balanced, just capital. Enter the all-weather strategy, pioneered by Ray Dalio. This approach doesn't rely on forecasts, it prepares for all outcomes. Risk is allocated across assets designed to perform during growth, recession, inflation, or deflation. Stocks, bonds, gold, commodities, and treasury inflation-protected securities, also known as TIPS, are weighted by volatility, not price. Risk parity replaces blind allocation. Alternative strategies like the permanent and golden butterfly portfolios offer simpler or growth-enhanced models while preserving defense. These frameworks aren't about chasing highs. They're about staying solvent when others falter. In a market where old assumptions no longer hold, resilient investing isn't nostalgia, it's evolution. The future belongs to those who diversify by design, not by habit.
Dana, for years I've seen headlines that the 60-40 portfolio is dead. What's your take? Have markets shifted and changed your approach to portfolio construction?
Well, they really haven't changed our approach, but we weren't, what shall I say, blind followers of a 60-40 annual rebalancing process to begin with. So I think of the 60-40 portfolio the same way I think of as the 4% rule. It's a broad general guideline. It wasn't meant to be this rule that you follow to a T, like a stoplight or like traffic signs. It was meant to be just, these general guidelines that help you gauge your direction. And so, looking and listening to the intro, when I think about risk parity strategies, I'm a big fan of, there's a lot of different strategies. It's very confusing for the consumer out there to hear, bucketing and risk parity and 60-40 and all of these things and think that one is better than the other. They each have their different purposes. And we follow a form of, risk management that is designed to protect the worst case scenario, to essentially raise the bar and say, when we look over a retiree's lifetime over 30 years, how do we make sure the worst case scenario is not as worse as it could be? And that is, in a sense, a form of risk management. It's a different way of getting there than the risk parity strategy. When I look at risk parity, it's a little bit more focused on volatility year by year versus looking at volatility and outcomes over a portfolio's lifetime. And so they are both risk management strategies. There's a lot of risk management strategies. 60-40 with annual rebalancing would be a risk management strategy. And I think it all comes down to being really clear on how you define risk. What is the risk metric you're measuring? Is it outcomes over a lifetime? Is it outcomes quarter by quarter? Is it outcomes over, an annual volatility metric? Depending on how you define that, that's going to lead to different portfolio strategies that best protect against that risk.
Jacqueline, what's your take? Do you include alternatives or annuities in your client portfolios?
Dana makes some really great points that we have alluded to here at Golden Wealth Strategies. So one of the things that I think we need to do is we need to zoom out and look at this big picture first. Okay, so first, for the average listener, you need to identify where you are in your investing journey. Okay, because if we take the history and the reason why the 60-40 portfolio has been that gold standard for so long, the history of this is there was a gentleman, William Bengen, he came up with the 60-40 portfolio. And so his research was done to figure out, as Dana said, what that 4% rule is, okay? And for those who are new to this, the 4% rule is just how much can you safely withdraw from your portfolio every year without running out of money? And so if we are in the retirement phase of life, which most of our clients are, and we're wanting to start pulling from our portfolio, we need to figure out how should that portfolio be allocated so that I don't run out of money one day. And so the way that we do it at Golden Wealth Strategies is we've taken Mr. Bengen's research and history and the studies. We've taken all of that information, and I would say that we've added to it. Okay. And so in our process, once a client gets to the point where they're ready to start actually withdrawing money out of their portfolio, this is where we take a close look at, okay, does the 60/40 portfolio work for you? Or should you be in some other sort of allocation? And so depending on where our clients are in their investing journey will dictate how the portfolio is designed. And so for those who are maybe a little bit younger or maybe a little bit more risk averse, maybe we have some alternatives in the portfolio. But it just depends on where the investor is in their investing journey.
Thank you for that. Yeah, I think relating to the segment video, I mean, just speaking really quickly for myself and my clients, I think that things have evolved a little bit because there are more choices when it comes to different exchange traded funds and different investment strategies. So whereas historically at Runnymede Capital Management, we might have had a 60/40 portfolio, but then we'll tilt, right? It's not 60/40 and just set it and forget it. It would be 60/40, but kind of plus or minus 10% on the stock side. So at certain times of the economic cycle, you're getting more aggressive. Other times you're getting more defensive. And when you do that in a taxable portfolio, you could have taxable event where you have to pay capital gains tax. These days, there are tactical investment strategies. If it's inside an ETF wrapper, may not have, well, it may have tax advantages where you're actually not triggering capital gains. So I'll go to Kem, who is the CPA among us. How do you bring tax strategy into the conversation when discussing asset allocation or diversification? Oh, you're muted, Kem. Let me see if I can unmute you.
Can you hear me now?
Yep.
I don't know why. But one of the things I was going to say, as a CPA, I work with financial planners, CFPs, and other, of course, financial advisors when it comes to building out the portfolio. And on our side as a CPA, we want to make sure that what's being done is tax efficient. So looking at whether or not it's in a taxable account or not, whether or not there could be some tax strategies at the end of the year, like tax loss harvesting, where an investor may sell off certain type of assets at the end of the year, underperforming assets, just to kind of offset any capital gains. So looking at all of those different things before, typically at the end of the year, that's really helpful when it comes to determining what tax strategies that we can work along with the financial advisor or CFP in this case. So just being really instrumental with those different tax strategies.
How do you advise clients on diversifying without triggering unnecessary tax events?
It really does depend. And actually, the ball goes back into the CFP, into the financial advisor's court, because our responsibility is just to review, to work along with the financial advisor and to see whether or not what we're doing on our side will work for them. So let me give an example. It's not wise for us to say, okay, maybe you shouldn't have this type of investment or not, because it depends on their risks, on so many different factors, the long-term goals. So that ball really does depend on the CFP, the financial advisor, making a portfolio and us working with them to make sure that we are keeping taxes in mind as they build those portfolios out.
And I was thinking about, I don't want to leave like this open loop. I'll ask all our panelists, are you familiar with this permanent portfolio or the golden butterfly portfolio? I will confess that I've been at this for 26 years. I didn't know.
No,
I can say, go ahead.
No, I mean, we're Golden Wealth Strategies, but we don't implement the Golden Butterfly portfolio. Our portfolios actually are typically called all-weather portfolios.
Okay, so yeah, maybe not that well known. The permanent portfolio created by Harry Brown, an investment advisor and author, introduced this in the 1980s. And it's designed to preserve and grow wealth with minimum volatility. Some say that it's a little overly conservative, but his allocation is 25% stocks, that's for growth, 25% bonds to protect against deflation and recessions, 25% in cash or short-term treasuries, and 25% in gold for inflation or currency crises. And then the golden butterfly portfolio, which sounds very cool, popularized by the financial blogger Tyler at Portfolio Charts. It's slightly more aggressive and growth-oriented compared to the permanent portfolio. And that allocation is 20% total stock market, 20% small cap value stocks, 20% long-term bonds, 20% short-term bonds or cash, and 20% gold. So together, we've all learned something today.
Andy,
We did.
there's also a golden ratio portfolio that is a risk parity strategy put together, I believe, by Frank Vasquez of Risk Parity Radio. And so there's all kinds of these golden portfolios that I didn't know much about before today.
I love it. We're all learning together. Let's go to segment 2.